Hi there and welcome to Cryptoarcade, and this video we're going to talk about stochastic. This is another very popular indicator that is applied to traders' charts to help them time entries, and it helps describe the market and what's going on. So the stochastic indicator, here we're taking a look at the trading view charting package. Click where it says indicators up above. You could just type in stock, S-T-O-C-H, or stochastic. You can even spell it out, but if you have a hard time spelling, you can just type in stock and the search feature will build it up for you. Now there's a couple of different stochastic out here. You'll see a stochastic, you'll see a stochastic RSI. The stochastic RSI is a little more complex in its calculation, and so we're going to go with the simple stochastic. Now they're going to do about the same thing. So I've added stochastic here to the chart. They're going to do about the same thing, but the reason I would lean towards the regular stochastic versus stochastic RSI is that if there ever comes a point in time where you want to take your strategy and send it to a coder and have them create an algorithm for you, the stochastic is going to be a little bit simpler for them to create, and it'll cost you a little less money. It's a little bit cheaper. And so it's for that reason only that I would say lean towards the stochastic. But if you want to use the stochastic RSI, you're more than welcome to. What I'm talking about in this video is going to be similar to how you would apply to the stochastic RSI. So the stochastic is it's a bounded oscillator. It appears at the bottom of the chart. It's bounded because it will be contained between 0 and 100. And you'll see it just kind of oscillates up and down between 0 and 100. Now we've got two horizontal lines showing up via the stochastic. The top horizontal line is set at 80. So anything that appears above 80 is considered to be an overbought market. Additionally, anything that shows up down here below 20 is considered to be an oversold market. Okay, and this is going to apply very similar to the RSI, which you watched in the previous video. One of the most popular strategies for using stochastic is when the lines come up into overbought territory and then cross back down. That'll be used as a sell signal, and on those occasions when price is down into oversold territory and then crosses back up, that would be used as a buy signal. That's the most common method of using it. So let's check this out on a chart. This is a daily chart for Ethereum. I'm just going to scroll back a little bit, and I want you to take a look. You know, this is a real nice uptrend that we've seen with Ethereum. And what I want to highlight to you is notice the amount of time that stochastic has spent in overbought territory is a lot greater than the amount of time spent in oversold territory. So you see here, there just wasn't a lot of instances where stochastic was down here in oversold territory, but stochastic spent a lot of time in overbought territory. So whether you're using stochastic, whether you're using RSI, one of the most important things that you need to do when utilizing these tools is to apply some type of a trend filter to it, because clearly Ethereum was in a strong uptrend during this period. And while it was in a strong uptrend, the oscillator, in this case stochastic, appeared overbought, spent a lot of time in overbought territory. Whereas during this uptrend, there was only limited instances where it was an oversold territory. And in fact, when it was found to be in this oversold territory, we actually received some decent signals from it. And so again, the way that you would want to use this is when price comes down. So there's two lines here. Let's zoom in a little bit. So there's two lines, and you got the blue line, which is going to be the leading line, and then the orange line, which is going to be the lagging line. And so when the blue and the orange line are down into oversold territory, and then when they cross, that's going to be your signal to buy. So if we take a look at this guy right here, it crossed right here. So this would have been the signal to buy. And, you know, based on that signal to buy, obviously it was a very, very nice uptrend to the upside. And that's the one thing to keep in mind, is that price was in a strong uptrend. And so therefore, you want to follow the direction of the trend. You want to buy when the market is in an uptrend, and you want to sell when the market is in a downtrend. And so here, because the market is in an uptrend, we want to filter only for buying signals. And so this would have been a buying signal here. And if we move forward, very strong uptrend, stochastic, you know, hardly dips down. So here's another signal. We've got both the blue and the orange line in oversold territory. We're ignoring all of the overbought signals because this is an uptrend. And so this would be another buy signal. This buy signal would have been very beneficial. Here's another buy signal where the blue line crosses above the orange line, while both of those lines are in the oversold territory. That would have turned out to be another good buy signal as well. And then we get the summer of 2021. This is where we went through a 50+% correction in crypto in a very short amount of time. You'll notice how the market starts spending more time in oversold territory. And the level of where stochastics becomes oversold is a lot deeper than what we saw back here. More time in oversold territory, and it's much lower. But eventually, it would have pulled out, uptrend resumes, and then it spends more time in the overbought territory. So that is the most common method that traders will use on stochastic. Now, there are a couple of different settings. If you were to go out and do some Google searches for common settings for stochastics or stock, you're going to find there's a couple of different settings. Now, this was the default setting that was in place. It's a 3-input setting. The default was 14, 1, and 3. Now, in my mind, there's actually 2 different common settings that I would encourage you to use. And that would be using a 14-3-3. And basically what that does is it smooths out the blue line. So basically, if you remember back from the MACD video, we had the MACD line and then we had the signal line. And so in this case, the orange line is simply a moving average of the blue line. And so by smoothing out the blue line, we're going to get a much smoother orange line as well. And so therefore, the instances of just having a lot of crisscross activity when the market is overbought or oversold will be diminished. And so that's the benefit of using a 14-3 and 3. Now we could even smooth this out a little bit more. So I'm actually going to add another version of stochastic to the chart. Okay, so the other common setting that I would recommend is a 15, 5, and 5. And I want to share with you just the difference that we see between the 14, 3, and 3, which is the top stochastic, and the 15, 5, and 5, which is the bottom stochastic. And you'll notice when we go 15, 5, and 5, it just slows down the stochastic even more. And so it really depends on how clear of a signal you want to receive and how quick of a signal you want to receive it. If we just take a look here at these instances where we get a crossover. Okay, so this is where we would have gotten the crossover on the 14, 3, and 3. And notice on the 15, 5, and 5, the orange line hasn't even come down to meet the blue line yet. So there's really a little bit of difference between them, but not a lot of difference. In fact, if you wanted to use the 15, 5, and 5, because it is such a slow, it really smooths out and slows down the moving averages, I would even encourage you to turn off the orange line, and that way you could just use the blue line and it would act a lot like the RSI at that point. So you notice, here, let me move this one up to the top so it's a little bit easier to see. But you'll notice that when it comes down and touches the oversold territory, you could use that crossover as a means to buy and sell. So right here, you would have had a crossover. There would have been another crossover here. Would have been another crossover here. You know, all of those would have led to really nice buying opportunities. But remember, you only want to use them in the direction of the trend. Now, there is another popular strategy that traders will use with stochastic, and that's looking for divergences. And so I'm looking on the chart right now to see if I can find any divergences. And let me get this out of the way. There we go. So we're looking at the 14, 3, and 3 stochastic, and basically I'm looking for divergence, and this would be an example of it right here. Okay, we've got a situation where price punches a lower low, but if you take a look at stochastic punches a higher low. And so this is an example of bullish divergence. And the indicator is not following what the price is doing. And so that is often symptomatic of what happens at important turning points in the market. So in this case, since price was moving lower, the indicator is not following price lower, and therefore that suggests that we may be on the early edges of seeing some bullish price action. Sure enough, boom, prices started to take off to the upside. That's one of the reasons why traders like the stochastic, is that the stochastic indicator tends to follow price pretty good. And so there's just not as many divergences that show up on stochastic as what you'd find on RSI. Speaking of RSI, let me go ahead and add this back to the chart. So we're going to have stochastic and RSI on the chart at the same time. And we've gone over several indicators up to this point in the video series. And the thing that I want to highlight with you right now is that adding more indicators to the chart is not the answer to providing a better signal. Okay, so you can have stochastic, you can have RSI on your chart, and they're going to give you similar signals. Notice how they're both overbought at about the same time. They're both become close to oversold at about the same time. They're never, ever going to always line up. And so therefore, what you want to do is you want to pick which of these indicators you like the most and just use one of them. You don't need to use both of them, just use one of them. And the more important thing that's going to give you higher probability signals is going to be filtering the market and the direction of the trend. So in this case, when the trend is up, filtering your stochastic signal for only buy signals, or filtering your RSI signals for only buy signals. That's the key to getting you some better, higher quality signals. That's more important than adding a bunch of indicators to the chart. All right, so that's all the time that we have here for this video. We hope you enjoyed it, and we're going to move on to the next video where we're going to cover some candlestick patterns and how they can help you identify some important turning points in the market. So we'll see you in the next video. Bye now.